Welcome to Markets Now. I'm Michelle Rook with Kevin Duling with KD Investors. We did see a mixed trade in the grains, livestock futures mostly higher. And Kevin, starting off over in the grain complex, tough day down in the wheat, some 2-year lows in Kansas City wheat. Are we just seeing more technical selling, or was there some fundamental reasons for the market being lower today?
I think we've got a little bit of both. You've got the trade reacting to rumors of Russia eliminating their export duty. I think that's getting priced in right now, but you've also got weak charts, and so the hedge funds are adding on to their short position.
Winter wheat rating also came in well above a year ago at 47%, good to excellent. Do you think that was a little bit of a psychological blow too?
I'm sure it was. Yeah, we're going to start this year off much better. Last year was pretty much a train wreck for that region the whole way through, with strong soft red conditions, but this year is looking different with much better hard red winter country. And the question is acreage, how, and I don't think there's an expectation that we're going to see much higher acreage, but with the pricing the way it is, I really don't think so. I think it's going to be flat with last year. So
are we down at a price, do you think, on wheat where we are stimulating demand?
We certainly are. We've had fantastic sales in the export report the last 4 weeks. I think to reach the pace, we've got to be between 170, 190,000 tons a week. And we're running, I think our four-week average is between 4 and 430,000. So we're certainly well above that pace. It gets a little muddy when you break it down by variety, with the soft wheats doing very well. Hard red winter has been the dog. We have seen Chinese interest the last couple of weeks, and I would guess we saw more of that on Monday this week. So I think we're there. It's just, we may have to drop another 30, 40 cents to wash the thing out and before we can get some legs under us. But yes, we're at a very good demand level right now.
Yeah, Kevin, you have told me before that really fundamentally there's not a reason for the wheat markets to be down here at these levels, is there?
If the USDA framework is anywhere close, no, there really is not. Because right now we're punishing producers who own wheat, punishing anyone who owns it. And, if you look at the long-term demand chart, next year we're looking at a, very large increase in demand just based on history. We've had 4 flat years in a row, according to USDA. I think that's accurate because the last 2 years we've had, prohibitive amount of grain, and so the demand wasn't able to be realized. This year, a little different framework, but still the same demand level as the last 3. Anytime we've had 4 years of flat demand, the next year's been 30 to 40 million metric tons higher, and we're not on pace to come anywhere near that. So on production, so you can't punish producers that long and expect to have record production next year. And it's going to take record production to meet the demand curve next year. So I'm excited about this market. I hate it in the short term. The short term is just punishing, but at the end of the day, it's going to reverse at some point, and I think we're going to see some fantastic opportunities in the next 6 to 8 months.
Yeah, let's hope so, because really we've just had too much wheat coming out of the Black Sea region that's been competing against us, right?
Oh, certainly. And the hedge funds key off of whatever Russia does and whatever their FOB price is. That's, the funds try to push us beneath those levels. And, there's so many questions. It's really hard to get accurate information out of there. I watch their weather close, and whoever follows along with me watches their weather close. And we look at that, and we saw the high pressure ridge over their spring wheat region pretty much the entire growing season. They had no rain. They had maybe 2-3 days of showers, and for them to suggest that they had a great spring wheat crop when Kazakhstan across the fence had a horrible crop, it just doesn't add up. But at the same time, you don't know how much Ukrainian wheat is coming across the fence and getting bogged down at Russian ports. It's very, very difficult to get real information out of there.
Let's talk about soybeans as well. A little uptick here today. Was that just a little corrective buying and some help from the soybean meal market, or what was going on there today?
Partly, I think that's a good chunk of it. Again, it's kind of like corn. It's in a holding pattern, waiting for the South American weather to show its hand more. You still got still got that pattern entrenched. Until that pattern breaks up, this market has a potential to go quite a bit higher. There are some shifts in the weather coming on the models in the second half of the second week, but they're not enough. There's still not enough rain in that Mato Grosso area, and still way too much south and east of there. So this you've seen the cancellations by China, and so there's certainly some hope in this market. I holding on. If the weather pattern stays as it is, I think we're going to see some great numbers. If the weather pattern shifts, then we probably should be pretty aggressive sellers.
Yeah. So, I talk about the meal market. We scored new contract highs on Friday, and then we kind of scored a bit of a reversal and had some profit taking. Is that all it was in that meal market? Was just some profit taking, either just in meal or with the meal oil spreads? I mean, will we go back up there and retest those highs, you think?
That's a good question. That's a really good question. I guess I'm with you, thinking so far it's profit taking and that we still have a chance to get back up there, but it ran away fast enough that it concerns me a little bit. It's like, well, if we can't get the funds on board, more so with that market, then it could be done. So that's a good question. We're just gonna have to wait and see. I don't have the crystal ball yet on that one. So.
Yeah. I'm not sure anybody does. So soybeans higher, wheat lower, corn kind of got caught in the middle today, but that market really is pretty stuck anyways, isn't it, Kevin?
I think so. I look at that chart pattern. It's a fantastic saucer. We got a saucer bottom in place there. It looks great. I don't want to see that market move below about 476 in the December. That's got to hold, or else it's going to void that big 90-day base that we've built, and I don't want to see that happen. So I've got my clients prepared. If we do start fading below that, then we've got some actions we're going to take. But if the weather pattern stays as is, then we're going to stay as well and expect some better numbers. But today was a little disappointing. Or yesterday we closed up a penny, and would have liked to have seen it close up closer to the highs on the day, but we just didn't do it. We need another week or two of watching these weather patterns.
Yeah, definitely. And the cattle market mostly higher today, but are we just continuing to consolidate off the October lows? And is it possible we will not go back and retest the highs at some point?
It's possible. Historically, cattle makes a nice long-term high. It doesn't make spike highs like the grain so much, and so I would expect it to not fall completely out of bed more. I'm a little concerned about the hedge fund managed money positioning. They've dropped their net long by about 70%, and if they want to get completely out of that in reverse, and especially if the stock market continues to struggle, this the highs could easily be in, but supply side, supply demand side says that we're not going to fall completely out of bed on the cash market side. So, we're wait and see, but I guess I'm leaning that the highs are in, but we're still going to go up and get near them again. I don't think we're going to fall clear out of bed for good here. I think we still got time, but we could have seen the highs. So,
well, in part it's because of what you just said. The cash trade has been pretty impressively holding together here, hasn't it?
It has, and it should. I mean, it should for the long term. I mean, the numbers are just not there yet, and the consumer is suffering a little bit, but they're not broke. They're still going to buy beef on any pullback. If prices ease a little bit, the demand's going to be there. Certainly not bearish the cattle market. Like I say, I don't know if there's a reason for us to continue any higher than we've been.
Of course, some of that fund liquidation may have been tied to, some of these concerns about macroeconomics. We do have the FOMC meeting coming out tomorrow, and so that'll be widely watched here, won't it?
It will, yeah. I wish cattle wasn't tied to the stock market right now. It's not a healthy looking market, in my opinion. I know there's been some good numbers, but there's some fascinating stuff. We just brought up the energy stuff. The energy sector continues to impress with the demand outlook. So, maybe this economy is going to hang in there. When you look at the government spending, you look at the overall picture, it scares me to death. So you got the dollar continuing higher, which is hurting everything. and yet our spending power seems to drop at the same time. So it's just a bizarre macro setup. I think we're going to have turbulent waters here for at least another 18 months, I would guess.
Yeah.
So
A lot of moving parts and a lot of interesting money flow for sure. All right. Thanks for joining us. That is Kevin Duling with KD Investors and Markets Now.